Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 11th of August. I'm Daniel Lam, your host for the podcast. This week, all eyes are going to be on the US CPI figure. Now, this figure is of even higher importance this time because the non-farm payroll missed earlier this month. So if we get a hawkish inflation number, it can tilt risky assets towards consolidation over the near term. Now, an FAQ that we've been getting is that with all the talks about US unexceptionalism, will equities in the rest of the world be able to withstand a consolidation in US equities? So let's look at the positives. If the US dollar does weaken, that lowers the import cost for the rest of the world, and that is positive for equities in areas such as Asia ex-Japan. And fund flow out of the US would, in part, filter to equities in the rest of the world. But as the Bill Clinton presidential campaign in 1992 would say, is the economy. So that is a universal truth, whether it is for the US or not outside the US. And the latest macro figures are not so outstanding for the rest of the world. So for example, Germany's June factory orders missed expectations. Orders fell 1% month on month, slowing to 0.8% year over year on a calendar adjusted basis from 6.1% in May. So the drop was driven by foreign demand, with orders down 3% and nearly 8% outside the Eurozone. Global growth has cooled but not collapsed, and a strong euro is weighing on exports, creating a difficult environment for Germany's export-dependent economy. July flash PMIs show new export orders falling across developed markets, and China, which is one of Europe's key export markets, remains under a deflationary bind. So the Chinese Caixin manufacturing PMI fell to 49.5, while services ticked up at 52.6. But the official PMI showed a weaker picture, with manufacturing at 49.3 and services softening to 50.1. So deflationary forces remain entrenched. Producer prices fell 3.6% year over year, deepening the prior month's decline. So the overall picture is pointing towards a consolidation in risky assets globally. So the environment calls for accumulation of portfolio hedges. So as we discussed in our podcast last week, we like adding gold on pullbacks, especially if it goes to the 3,000 to 3,250 area. We also like scaling into bonds with preferred maturity profile of 5 to 7 years when US 10-year government bond yield goes to the 4.25 to 4.5% area. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.